The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and good morning to our friends in the lands down under, and I think early afternoon across the ditch in New Zealand. Lovely to have you with us. How's the volume, folks? If you could, somebody could type in the question box. Let me know that you can hear me all right. Yes, Mr. Deck from the UK, a long way away. Good on you, mate. You can hear me. That's a big start. Well, excuse me. What a wonderful time to be a trader. Look at all the people we've got today. Let me just run through quickly. Akshay, good to have you with us. Albert, he's a tutorial guy. Good to have you with us, mate. Carol, lovely to have you with us. Carol, we don't have many ladies at the Daniel Code, but we certainly cherish them greatly. And you're most welcome, Chase, who's my non-smoking advisor, who's been hounding me for years and years. And, of course, as you know, I'm giving up the smoking. Chase, have you? Dean, he's a tutorial guy. Good to talk to you, Dean. I hope your trading's going great, mate. If not, let me know. Eric, the same for you, my friend, of course. Gary, George, Hank down in the Hunter Valley of New South Wales. Good to have you with us, Hank. John, a couple of Johns, one from Coffs Harbour. Good to have you with us, John. He's still the beautiful, beautiful Coffs Harbour down there. Lovely, isn't it? Okay, let's see who else we got. Oh, lots of them, everyone. Marco, Michael, he's a he's a tutorial guy. Good, Murph, as usual. Peter, yeah, Philip, Robert, Scott. Tom, the wealth fund manager from Florida. Hope it's lovely down in Florida for you, mate. Todd Timmons, he's a voice from the past. We haven't heard from Todd. He's a long-time Daniel Code guy and been a long time. Oh, John's the Coffs Harbour guy's in Coonabarabran at the moment. Okay, mate. That's a bit of a change of atmosphere for you. And, of course, Vicky, lovely to have you with us, Vicky. Right, folks, amazing stuff happening, isn't it? Lots of excitement. America is besotted with the presidential elections, which are still a long way away. They're late next year, but it's in full flow, and markets are a bit twitchy about some of the stuff that's going on. So anyway, let's move on and have a look what's happening around markets for us. You know already that Daniel Code proprietary ratios control time and price. That's a big difference. And today we're going to spend quite a lot of time looking at analysis of long-term charts, because with every form of analysis that we're looking at, and we're trying to find some clues about what the US equities are doing or are about to do, you have to start from the long-term charts and work backwards. And I don't think we spend enough time. We're all guilty, including me, of not spending enough time on the long-term charts. It doesn't take much time. You've just got to, refresh your eyes over the weekend and be aware of what the major trends are. So, as we're looking at this form of analysis we're going to use today, we're going to use the Daniel Code trading channel. And the question, of course, is why use this tool? It's unusual, and you may not have seen it before if you haven't been with us, although I pepper the Daniel Code folks with it pretty well all the time. It's a very specific tool, and it has very specific rules that make it very difficult to data fit. The biggest problem with all of these drawing tools is that if they're not stringent enough or specific enough, you can data fit quite easily and you get on the wrong track. This thing you can't because of the very specific rules that require it to be a valid DC trading channel. And we use a different standard deviation multiplier to the normal mathematical model, which is a fixed model. Normal standard deviations are 1, 2, 3, whatever deviations from the median or the mean We don't do that. We actually use a very specific Daniel code number. The tutorial guys will know, and it's the number that represents times, and all of these trading channels, of course, are various forms of angles. And the thing about angles, for every chart you look at, every bar has not only price points, but it has time points as well. And every data point has those two combinations, which we generally don't pay any attention to because very few people understand how powerful time is in trading. By using the Daniel code ratio for times, plural, we're letting the market define for us its natural standard deviation, one channel either side of the mean, which is quite different to what you'll get with using the normal mathematically understood standard deviation. So I want to assure you that this is a very legitimate tool. It tells us what it tells us. It doesn't tell us the be-all and end-all of life, but it does tell us some very, very significant insights that you don't get just looking at a linear chart. So here's our first chart we're going to look at, and of course today we're primarily concerned with the US equity markets, and to analyze that we use the S&P index because it's a broader index than the NASDAQ or the Dow. And it's the S&P, it's a chart of the 500 essentially largest corporations on the US stock exchange. So we're using the actual index as opposed to the futures chart. It's not really that important. You can do this analysis equally well off a futures chart. But I want you to train your eye, and I want to show you a little bit of history of what's happened over time. So this happens to be a 24-day chart. At the Daniel code, we use multiples of our basic numbers that come from the code. Gann used to say, if you are worthy, I will tell you the number, and he'd tell you if you bought him a Buick or contributed enough money, the number is 7, which of course it's not. The number is actually 6. So we use multiples of that to set up our long-term chart. So we have a 6-day chart, a 12-day chart, and a 24-day chart. That's what we're looking at the moment. So that's really, I suppose you'd call the Daniel code monthly chart, if you like. And we're starting off here with the .com top. This is April 2000. And you can see, looking at the linear chart, when you look at a linear chart, you're looking at horizontal price levels. And you can see the market made a new high there in April 2000. That was a confirmation of the uptrend, just what you'd normally expect. And then it goes sideways for a few months and fritters itself away. Let's have a look what happens if we look at a different chart of that. This is the same chart, but we've now put on it a Daniel code trading channel. And how this works is it has some very specific rules. It has to start at a certain place, and it has to keep contact with various points in the market. In this case, it's starting from a significant swing low back in early 1994. And you can see there's a collection of blue lines here. We can make as many of those as we want, but basically the darker line going up the center, that's the median or the mean, and the lines on either side of it are 1, 2, 3, or 4 standard deviations from the mean. And you can see in this particular chart, it starts off from a swing low. That's where we have to start. We have contact with what's called the first push up, which is actually this little tiny bar way back here, 2 bars after the low. And again, it comes back into focus as we move into late 95, early 96. That's the contact with the first push up. We have to hold that, or it ceases to be a valid Daniel code trading channel. So if we've got those 3 points lined up, We then look, there are some variabilities in it. You can extend this channel or reduce it, but we do want to show its validity by having contact with the important counter trends as well. So you can see here how this low here is caught very, very precisely at 2 standard deviations from the mean. As this market goes up, keep an eye on this solid blue channel and the channels either side of it, and watch the extension as you go through. This is the extension right here, which is the mean, an extension of the mean. But look what this market's done. It's been making its highs at 2 standard deviations from the mean. It's done it there, it does it again here, and it does it several times along here. At this high here, this is not at 2 standard deviations from the mean. This is actually at best 1 standard deviation from the mean with a bit of optimism to get it there. You can see there's a little gap above it, and that tells you that this chart is in a condition of failure. It doesn't tell you it's going to crash. It doesn't tell you anything as exciting as that, but it gives you a warning that this chart is in a condition of failure, and therefore it's much more susceptible to a correction. Let's have a look here. I'm trying to run through a little bit of history for you here, if you bear with me. It's why use extensions rather than extending the blue lines? It's important to know excuse me, that you have those 3 points of contact that I've just talked to you about. If you just extend the blue lines indefinitely, it stops being a Daniel Code trading channel. It becomes a regression channel, or a regression channel best fit, and that's useless to us. It's the application of those rules which tie the blue lines to the price and time levels that the market's already created. That's exactly what makes those extensions valid. And if you just try to use the blue lines all the way, you finish up with something that is not a Daniel Code trading channel, and therefore useless. We've moved the chart on a little bit here for your next slide, and you can see, let me just make sure you are seeing what I'm seeing. Yep, and this is the rundown to the 2002 low, which of course had 9/11 embedded in it. But you can see, looking at the linear chart, there's no failure of this chart. The low makes, each low progressively makes a lower low, and the excuse me, ultimate low here, which is November 2002, it's made a fresh low. There's no failure on the linear chart. However, if we then go and have a look at the angular chart on here, you'll see something entirely different. In this case, here's our valid Daniel Code trading channel. It's got contact with the first push down on 1 standard deviation of the mean, which it has to have. In this case, it goes on and on and on, and eventually it gives you some very interesting lows in October 2001, and that it's not a failure. They're right where they should be. Pretty dramatic stuff. Look at this. This is 1, 2, 3, 4 standard deviations from the mean. That's a pretty dramatic slope. But then look what happens at the main low, the ultimate low in November 2002, and the next one that comes 1, 2, 4 months later. Neither of those bars confirm the downtrend. In other words, they're stopping at, the first one is stopping at 3 standard deviations from the mean, and the other one, next one, is 2 standard deviations from the mean. Whereas to confirm that it's still in that Daniel Code trading channel, you need to have those lows heading at and to 4 standard deviations from the mean. It fails to do that, and that sets up the condition of being a failure. And you can see the market's failed in the downtrend at that stage, and that's something that you can't see on the linear chart. So by using this tool, if you can train your eye to follow through the blue lines into the extensions and see how extraordinarily accurate it is. Have a look at this. I mean, here's just off the 4 standard deviations, right at the 4 standard deviation, turns the market around completely. Here's the next one. This is closed almost exactly on the 4 standard deviation for the mean, and all of these meetings of target of price and time lead to reversals and rallies when they're a failure. Let's have a look now. There's the 2007 high. This is the same chart. These are all 24-day charts. Here's your 2007 high. This is a bit of a history lesson. There's the new high. No failure. The new high makes a higher high. That's what you would expect in a trending market. If the trend is in place, markets will make higher highs, or conversely, lower lows. So it makes the new high in October 2007 just perfect. There's no indication for failure there. Have a look at the entirely different picture you'll get when your chart changes to show you that same piece of chart, and with it is a Daniel code trading channel. Have a look here. This is the swing low. You start these channels from either the swing low or the closing low, as long as it's no more than 1 bar separating them. This DC channel starts from the swing low. This is the first push out, this little bar here immediately after the snapback reversal. We have to hold that on the 1 standard deviation line to be valid. In an uptrending channel, we need to hold it what we call the first push up. If it were a downtrending channel, the opposite applies. We have to hold that 1 standard deviation point on the first push out. So this market goes on. We know this is a valid Daniel code trading channel. It goes on, and you can see up here it's gone through its 1 standard deviation for the mean, closes right at it, has a good look at that line, and then that causes a correction. Correction goes on. Eventually it gets down and makes this low in October, November 2005. And look how perfectly the Daniel code trading channel captures that. That low happens precisely at 2 standard deviations from the mean. It goes on a few more months, and it tests that low again. It goes a bit through it. It might have even got to 3 standard deviations from the mean, although I don't think it quite did. But the key point for us is the highs have been made at this line here, 1 standard deviation from the mean. And all the way along here, this line here is the 1 standard deviation from the mean where the cursor is. The market's not getting there. In fact, what the market's done is it's battled and battled for months and months, and it's got back to the median. That's all it's done. So there's the momentum highs there. 2 months later, there's the chart high. Neither of them can pierce the median, and neither of them get back to 1 standard deviation above the mean. So that puts the market right there into a failure pattern. Doesn't mean the market's going to crash. It does eventually, but at this stage on, at all stages, you are saying this market is in a failure condition. Okay, so let's move on a bit. Here's the current chart. This is the up-to-date chart. You can see it's been a fantastic rally, a very, very dramatic rally. Same thing here. We're starting from the closing low, the last close before the swing low. Here's the first push up in April 2010. We have contact with 1 standard deviation from the mean, the first channel sloping upwards. That's the essential condition we have to have for this to be a valid DC trading channel. Market moves on, we get a correction. It goes down to not quite, misses 2 standard deviations for the mean, but that's where it's heading. Battles along, it gets above 1 standard deviation for the mean. Here's its major correction in 2015. This time goes down, look what it does. 1 standard deviation from the mean, rallies 2 months, down 2 months, and this time it's held right at that low by the blue line that's 2 standard deviation for the mean. We then stop the DC trading channel. This is as far as it goes to be valid. We can't extend it any further than this. This is likely about April, May 2017. and that's as far as it can go. So we stop it at the stage, we extend it as far as we can while it's still compliant and forming a valid Daniel Code trading channel, and that's what we've done there. So that's where we stop it and the extensions take over. Look what happened in the great Trump rally here. This market now goes up, having never been over one standard deviation from the mean since 2009. Look at this rally in here. This is the Trump rally. 2 standard deviations from the mean is hit there. Up goes this market. 2 standard deviations from the mean. Down it goes. Look exactly where it goes. Now, we've stopped this way back here in 2016. And here we are in 2018. Look where it's to, the correction. Exactly 2 standard deviations from the mean. And then from there, I mean, you can take the view if you like, that's Newton's law. It's got 2 standard deviations above the mean. An equal and opposite reaction would be 2 standard deviations below the mean. Markets don't, I mean, they're very interesting when they show us that. And it's easy to get excited about that sort of stuff. But markets don't actually do that. They will do it just occasionally enough to titillate you and have you throwing your hands in glee and saying, aha, a great new discovery, Newton's laws, but they'll do it enough to tease you, but they won't do it on the time frames that we recognize often enough to be useful. So look what's happened with this latest part of this rally. Pretty fierce. Look, it's way up there, 2 standard deviations from the mean. So on the current chart, there's no failure, okay, at least on this time frame. So let's have a look at a different time frame. This is the 12-day chart. This is, if you like, a 2-week chart, if you like. So same sort of thing. It started from the closing low, up it's gone, up it's gone. Here's your 1 standard deviation from the mean that we're locked onto, makes it a valid DC trading channel. Here it does it again. This is the same market. Look, it's running up the 1 standard deviation from the mean all this time. Here's the first correction, just penetrates 1 standard deviation. Here's the next bigger correction. Looks like it's just gone through it, and it has on the close as well. Rallies back, it cures itself pretty quickly, and now it's hitting 1, 2, 3 standard deviations from the mean. Look at that. Okay, but look what's happened since then. Here's the next rally, very important. Doesn't get to 3 standard deviations from the mean. Here's the present rally up here. Doesn't get to 3 standard deviations from the mean. So in other words, on the 12-day chart at least, this market has gone into a condition of failure. Okay, let's have a look what we're looking at here. I think this is telling us that ever since this, here's your 0918 high, that was valid, that reached your 3 standard deviation of the mean. Ever since, all of this work, up and down and up and down, on the angular chart. What these are angular charts that combine time and price. In a way, they're sort of a secret momentum indicator, aren't they? Because you're seeing a momentum failure here that other people can't see. Okay, let's go down as we move through here. We know what's happening on the big charts. We have to keep moving down to get a closer time frame. This is the .com top again, but on this time it's on the 6-day chart, and you can see failures everywhere. This was running up the one standard deviation here, up into here. This is 1998. Look where these failures start. This is the first failure here. This is early 1999. Another high, another high. It takes a long time to work out these big patterns, doesn't it? But we're looking for confirmation on the angular chart. It's 1 standard deviation above the mean, which is way up here, folks. Just where that cursor is now. Well above. well above the word.com top. So you see this more, excuse me, the morning hay fever has arrived, unfortunately. You can see these failures more obviously on the shorter term charts. Here's the 6-day chart, which we've just looked at. This is the current chart. And this pattern, these three top patterns here, most traditional charters, they have discussions about these things. The discussions go on endlessly. But most traditional charters would call that a rectangular consolidation and an uptrend. The probable outcome from that is a further continuation of the uptrend. There are, however, other people who will tell you that's a pattern called Three Little Indians, the three consecutive highs, and that's a failure pattern. We don't use that stuff, so you don't have to worry your head about whether it is or isn't. The angular chart is telling you without any shadow of a doubt that this market has been in a failure condition since February 2018, which is rather interesting. Okay, and here we've brought this in to show you where the median is and where the DC standard deviation line is a bit clearer for you to see there. So, I mean, this is a market that looks terribly, terribly impressive, but it's got a fairly severe weakness in it, which can be fixed. These angular charts are time and price, and as time moves on, they can fix themselves, but this one hasn't yet. This is interesting thing to find that we've got a 59 cycle in time running right into the current bar on the 24-day chart. You can see where it started. It's way back in early 2008. In fact, it's the first high. It's what we call the high after the high. You can have a high before the high and a high after the high. The high after the high is often a interesting place to start a count from, a time count from. And what you're looking for here is the dominant time cycle in the S&P is 59, and it gives us tops on the 59 cycle. And you can see here we've actually got two cycles. The first cycle is the one that's got the 59 on it. This 118 here, this is actually two cycles. I know that the way the program works says one, it's actually two. So the first 59 is time, this is times, and it shall be for time, times, and then half, which you would know if you were a Daniel Code tutorial person. So that's just a by the by. Time cycles can have wonderfully damaging results on charts, or they can do nothing else, because in addition to what I'm showing you as a 59 cycle here, there are many other cycles running through these charts at the same time. Why is the 59 there important? Well, this is what happened at the 2007 high. This is an interesting pattern that goes from a high. This is a minor high where it started, up to the final high in 2007, and that was 59 on the 59 periods on the 6-day chart. So once we've had a time cycle elected, in other words, the market said, yes, I'm using this 59 cycle. Once you see that happening, the probability is that it will happen again. Time cycles repeat. So same issue, there's your 59, excuse me, right at the 2007 high. And here's the 118, which is the same thing. It says one, it's actually two. If the first 59 is time, this is times, and it gives us the closing low exactly to the bar. Remember, these time cycles are valid for plus or minus one period only. They are so exact, they won't be. If they're going to bite at all, they'll bite at or within plus or minus one period. So the 59 is traditionally the cycle that gives us tops. It can also give us bottoms. It can invert. All these cycles can invert, but you should at least be aware that we've got a 59 cycle in place on the long-term 24-day trading chart. Okay, excuse me, this is the US dollar index, which you can see has had a dramatic run up and an equally dramatic pullback. This is terribly important for a number of reasons. The administration in the US, Trump, is a low-interest, weak dollar man. And that's a classical businessman's approach. You have cheap, low interest rates, and if the dollar is weaker, it makes your exports cheaper, effectively, more desirable, and it makes your imports more expensive. So that's a classic condition that most economic managers would like to see. The difference with Trump is he's very open about it. He'll get onto the Federal Reserve and tell them they're useless and failures, and bellowing for a large interest rate cut. But what happens with the US dollar is vital, because so many markets, you think of all the commodities that are all quoted in US dollars, a whole lot of the movement that we see in currency, in commodities, is actually affected by US dollars. This is the classic, this is gold in the top panel here, and the bottom panel, DX, is the US dollar index. The US dollar index is a basket of currencies. It's the US dollar weighted against a basket of currencies. But I just want to draw your attention to this, that we've covered this fairly well, but some of you may have missed it. In here you have, this is gold. It's in a downtrend. It's in a downtrend. It's downtrend. Runs down until about November 2015. Then it reverses, rallies like hell. Look what the dollar's doing. The dollar's going down. Dollar makes its low, and a little bit later there's a bit of separation in the timing, but it's putting the low and it's starting to rally. And as the dollar rallies, so gold comes down. Here the gold makes a low, dollar makes a high. They separate again all the way along to 2018. Dollar makes a low, gold makes a high. In other words, periodically through time, gold has an inverse relationship with the US dollar. In other words, dollar up, gold down. Dollar down, gold up. Way back when, and it's many months ago now, it's in our videos which are available at the website, I told you round about in here somewhere, I think, that the gold and the US dollar were breaking that relationship of the inverse correlation. In other words, gold started going up and the US dollar wasn't going down. I wrote an article about this many years ago that if you have a look right back as far as your data goes, you can actually see quite clearly these periods where gold is locked into this inverse relationship with the US dollar. When that relationship ends, as it always does, historically it's always resolved itself in favor of a boom market in gold. And that's exactly what's happened here. And some of you will remember that back in the some months ago, and that's continuing. The thing to watch for carefully, and you can see this on a daily chart, you don't need to go to a 6-day chart, watch to see when the relationship, the inverse relationship between gold and the US dollar is re-established, because you'll find that'll be the end to the very, very strong run that gold is presently enjoying. This is the S&P Index, folks, right up to date, and what we've done here is we've just switched over to the futures chart. This is the 057 chart from Trade Navigator, which is the continuous chart. How these work is they simply have the each of the front months is just simply tacked on to the chart without any adjustment for the rollover. And on this version of the Daniel Code trading channel, it starts at a swing low, which makes it valid, has one standard deviation holding the high, which also makes it valid. There's actually an earlier one in here that's not shown in this chart that goes straight up and runs off around about here in April 19. But it's valid because it starts at the right place and it's locked onto one standard deviation for the mean on the upside. And this is what the market's done. And this really, really big correction we had not so long ago, you can see that on a closing basis stopped exactly at 2 standard deviations from the mean. Pretty interesting. On this chart, this is the daily chart, you can see the tails going through, but it did stop exactly on the Daniel Code 2 standard deviation from the mean. That's right here. This was the close of this bar here. That was the lowest close. Right here you have a fractional break there, but not by much, and then immediately a reversal back up. So this market's fighting very hard to hold 2 standard deviations from the mean. It's oscillating between 1 and 2, but these are all part of a failure pattern. It needs to get it up to, at least to start off correcting this chart, it needs to be up at 1 standard deviation above the mean, which looks unlikely. So what does all this mean? Does it mean the high's in? Does it mean the market's going to consolidate for a while and go up to make massive new highs? Or does it mean something else? Well, one of the things that's going to affect this market very greatly is the US presidential election. And that's not for the historical reason that you would suspect, that historically there are all sorts of presidential cycles that you can chart, and they're quite extraordinary, the effect they have on markets. This is not that sort of an election. This is going to be very different because you have such a pro-market president at the moment. With Trump, he's a booster. He'd get the market up, get the interest rates down, and he's identified, I mean, he's caused one of the biggest rallies in history. No argument about that at all. And he's very much identified with the strength of the stock market. And it follows from that the result of the next presidential election, and indeed the House and Senate, the US elections are going to have a huge effect on what the markets do, because the US is at the moment by far the strongest economy in the world. And in fact, it's the only market in the world which there are not significant signs of a correction happening. So the best chance of keeping that market as buoyant as it can possibly be is Trump successful in his run for a second term. And to do that, we've got to have a view about what he's going to be facing. And I'm sure you've all got your own views of this. It'd be hard not to, because US media is totally obsessed with, well, they're not so much, I was going to say they're obsessed with politics. I don't think that's true. I think they're obsessed with the personalities in politics. But you see what Trump undoubtedly has been absolutely massive for US markets. He continues in that line. He's actively urging the US Fed to cut interest rates and cut them big. On the other hand, he's introducing a note of caution or a note of worry in the market because of this ongoing issue with the tariffs on goods imported from China. Now, there's a fair bit of sleight of hand here to try and convince the American populace that tariffs are not hurting the US economy. Well, that's just simply not true. Tariffs are another form of taxation. Yes, the importing companies or businesses are liable to make that payments of those tariffs, but eventually that is passed on to you, at the consumer. It's passed on to the consumer either through higher prices or reduced quantity. The favorite issue in food stuff, of course, is to make the can a bit smaller and charge the same price, as you well know. So that's a real issue. I think China are very, very strategic players. They're long-term thinkers. They have this massive history of thousands and thousands of years, and they're very well entrenched in their views of how they would address conflict. And I think there's no doubt that they're finding Trump a pretty tough nut to handle, which he obviously is, and I think there's more than a reasonable likelihood that they're saying, well, let's not hurry to deal with this tariff issue. Let's see what happens at the election. So that could give you the whole, another year and a half or more of turmoil over tariffs. And there are also indications that many US consumers, or not so many, the ones of great influence, like the major corporations, Apple's the best example, have already got in Trump's ear and said to him, look, these tariffs that you're putting on, we'll have to pay them because most of our manufacturing is done and assembled in China, so what we import in Apple product and phones in particular are going to be affected by the tariff, whereas our main competitor does the same thing, it assembles their product in South Korea, so they have the same or similar benefit of lower wages and less restrictive industrial laws, but they're not going to have, and that's Panasonic, I think, was the issue. It might be someone else, don't quote me on that. It might be, one of you will know. Anyway, you understand the point, that significant US interests are now in Trump's ear saying these tariffs are hurting us. And how does he stand up to that? I would think probably not well. I think there are people of great wealth and great influence in the world who Trump would naturally gravitate to as people he'd like to assist and be friends with, particularly those that are not nasty to him. And we can see already with Tim Cook having a private dinner with Trump and getting in his ear about tariffs on Apple product. I mean, it's actually hard to think of a less deserving company for tariff relief than Apple. I mean, the whole of their model is designed around regulation minimization, tax minimization, as they're the absolute leaders for it. What Dean say here, has the Russell shown greater signs of failure? Yes, it is, Dean. There's no doubt that the Russell is been weaker than the major indices, and it has been for quite a while now. I didn't want to do analysis on the Russell. That's a small cap index because that's an area that is, we know, significantly weaker than Nasdaq or Dow. So by using the S&P interest, we get a much we get a S&P 500. We get a much broader view of it all. So what happens in 2020? Well, I guess everyone's an expert because it's the unknown, isn't it? But if you look at it logically, Joe Biden's the leading candidate at the moment. I just don't think Joe's got it anymore. Now, I mean, I'm not an expert on American politics. In fact, I'm an expert on almost nothing except futures market. But I don't think Joe's got it. I think he's just tipped over that edge too far, or perhaps he hasn't had it for a while, but it hasn't been in the cold, hard light of dawn because Obama's been the superstar. I doubt sincerely whether Biden can handle Trump. Bernie Sanders, on the other hand, I think can handle Trump. I think he's a tough old coot who's been around a long time. But is he electable as a self-proclaimed democratic socialist? It just doesn't seem to have caught fire this time around. And that's because there are other younger and perhaps more attractive candidates who've stolen a lot of his thunder. And one of them is this Elizabeth Warren lady who is very close to Bernie personally. They're great friends. They have very, very similar platforms. But she is a super smart woman, and she's tough. I think she's a very tough lady. And I think she could handle Trump because she'll diffuse so much of his bravado and boisterousness by he would handle a man on the stage very differently to how he'd handle a woman. The point is that she's a socialist too. Her policies are very much very similar to what Sanders has been talking about, and she's going to tend to be, I think, a fairly fierce competitor if she keeps going up the ladder as a potential Democratic nominee. Is America ready to elect a woman? I don't know. I hear a lot about this stuff. It seems to me that women manage to insert themselves pretty much where they want to. I certainly don't think. I know that was an issue for Hillary, but I think that's because she was Hillary. I doubt if that's a general thing. So yes, be interesting to see. I would think that Trump's danger probably comes from Elizabeth Warren, or I should rephrase that: Trump's danger comes from himself first and foremost, and thereafter perhaps from Elizabeth Warren. But we'll see. We'll see. So what happens through there, and what Trump can achieve in the period he's got, it depends whether that's like 18 months or another term. But actually, for your question, what's the outlook for long-term US interest rates? Well, they're going up at the moment. The market wants higher interest rates. Trump is using all of his bullhorn, his megaphone, to talk them down by his constant quips and attacks at the US Federal Reserve. So just looking at this, we've laid out what the conditions of the market, and we know what the probabilities are. The probabilities are almost endless. That's always the same. That's the danger in forecasting. But there's some very specific things to look out for. A share market crash on its own is not going to cause a global recession. It'll be, if the share market does have a crash, and there's no evidence of that at the moment, it'll be because something else is having such a deleterious effect on the various corporations in the market that their profitability, their value is plummeting. So in 2000, we had the dot-com crash. I think that sort of thing, that sort of market crash is behind us. I think, the enthusiasm, the eyeballs, the clicks for eyeballs, clicks for value, I think we're past that. I think some of the major tech companies are very mature, very well established. I mean, economics will look back in their economic history class and be absolutely amazed at what the Facebook, Google, Microsoft companies have been able to do by avoiding competition, by killing competition through a combination of first mover advantage, highly predatory habit. With anything that looks new or interesting, they suck it up. and that total and utter dominance they have of markets. I don't think we finish up having any sort of significant .com problems, because I think the heavy end of the market is pretty mature and well run, because they've organised themselves to be in a semi-monopoly position. What's the other big risk that applies everywhere? It's real estate. 2002, 2007, 2009 crash. I know it was about, what are they called? Those specific contracts where they were passed, or the guy on the Big Short, all that sort of stuff, CD something. Excuse me. But really what it was about was the underlying, which was a market crash in property. And the question is excuse me, a likely scenario in the US? Well, not at the moment, but there are signs of weakness in some of the key trophy markets, Hamptons, New York in particular. But have a look what's been happening in Australia. Australia's a bit of a canary in the coal mine. It's had the biggest property boom in history. It competes with Sweden for the least sustainable property prices. Sweden and Australia, honestly, property prices are off in fairyland now. I have to qualify that by saying that that's really restricted to the two big capital cities, Sydney, which is the capital of New South Wales, and Melbourne, which is the capital of Victoria. Now, Australia runs this massive, incredibly bad, I should say, immigration program where we bring in per capita, based on our capital, size of our population, we have the highest immigration program in the world. And we do some really strange things. You wonder who's running this program for the government and why, but there is some, honestly, it's hard to get your head around. It's hard to enunciate how badly managed it is with the selection. But anyway, one man's opinion is another man's ridicule. So leave it on the basis that we have the highest per capita immigration in the world, almost all of which goes into and around two cities, Sydney and Melbourne. They're the big business centres, the big business hubs, the big industrial centres, and that's where the migrants go. And the prices that we've had in Sydney and Melbourne, in fact still have, are absolutely extraordinary. You would walk, I promise you, there are cities where you would walk in and say, I want to buy a house for $1 million, and you'd be embarrassed with what you were shown. You wouldn't walk in to inspect half of them. I mean, it seems to me beyond belief that prices have got to that level. And in the middle of all of this, there were big calls for a Royal Commission into Australian banking services. Now, a Royal Commission, it's a British concept that governments can use if they want to make serious inquiries. It's usually run by a retired judge. They have all the powers for court. They can subpoena documents. They can subpoena witnesses. They can compel testimony. And Australian laws are a little bit different to the US, but they can get to the bottom of what they want to do. The Australian government, the Liberal National Party government that was then, still the same government now, just changed the leader, changed the Prime Minister, thank goodness. It was very opposed to the Banking Royal Commission, which were quite understandable, because big banks, the big monolithic banks that we have, they're the natural clients of the Liberal Party, which was the ruling government party. And you've all seen regulatory capture in every day. events with all governments finish up suffering almost, or I should say, it's regulatory capture that the people who are supposed to be doing the regulating are running the show, and that's exactly what had happened with banking. And eventually the government was forced, that's the only word to use, to call for a royal commission. But it was very really short. It was the terms of reference were created to make it very, very limited, and it was best a superfluous look across the top of financial institutions and banking, just the high poppies. It really get into the nuts and bolts. But what it uncovered was absolutely rampant wholesale fraud, corruption, and negligence across the whole of the Australian banking sector, with very, very few exceptions. And so it went through quickly, very superficially, and it ended. But just the issues that it found, just the touching of tender nerve that the regulators weren't regulating, they'd been captured. That's caused such a crackdown of fear and wonder in the banks. I mean, some of it was much of it, I should say, was totally corrupt, with individuals, particularly in some of these immigration areas, being appointed as de facto agents of the bank, earning commissions, big commissions to get loans through, and obviously with that incentive, a lot of the documentation there are ninja loans, you'd call them, wouldn't you? No income, no job. But that's fine, we'll get you a mortgage anyway. But that caused so much fear and anxiety in the banking sector that bank lending shut down considerably. Now remember, the price of real estate is a function largely of the availability of finance. You start trying to sell a house cash only and see how well you go. Then offer it with an 80% mortgage or a 90% mortgage. You really want to sell it, tell the buyers you can arrange 100% finance. The ability of banks to lend is a huge determining factor in house prices. And with the banks just squeezing back a bit after the Royal Commission, house prices dropped 10 to 15%. Now, I would have said, so what? That's a very, very small correction given what they've been up to. But it's created wholesale panic amongst agents, amongst all those people involved in the banking, financing, mortgage sectors, all of the tens of thousands of agents who are organising loans and charging commission to people. And it caused a considerable slowdown in the property market. What we then had in May this year is what I call a touch of Trump down under. We had a totally unpopular Liberal National Party government, equivalent to your Republicans in the US, that have been behind in the polls for 18 months, 2 years, more. Not given a chance by any pundits at all to retain government. And the big surprise, a la Donald Trump, a la Brexit, is that the population, the quiet Australians, as Hank says, no one went to jail, though. That's in the Frank Royal Commission. That was the problem, Hank, wasn't it? Plenty of them deserve it. Anyway, cut a long story short because time's running out for us. Big surprise, the National Liberal Party got back in. Since then, banks have been feeling happier, trying to push their lending, but the government and the banks have been making a concerted attempt to get people to have more confidence and to invest in real estate. And let me tell you a story. Interest rates were down for most people, average people, on their mortgage, were down in the mid 3%. I'd have thought incredibly generous by any view. Major banks have been ringing their clients saying, take out another mortgage, have another loan. We can lend below 3%. I've never known, maybe never's a bad word. I've had a long life and much has happened, but I honestly can't ever remember a bank calling me and saying, will drop your interest rates without even being asked about it. But that's what's happening. And the Reserve Bank of Australia, which is the Australian Fed, if you like, they've called for weird things, increases in public servant wages, if you can believe it, the most highly paid, some would say overpaid sector of the whole community. And you've got this highly responsible and respected Reserve Bank saying, pay them more, it'll help the economy. Then what's happened is the Reserve Bank has dropped interest rates here twice, very unusually, and banks are now originating mortgages, new mortgages, well under 3%. It's extraordinary that these most conservative people are acting as if the end of the world is near. And perhaps they know things we don't know. Perhaps they know lots of things. But to get a significant downturn in the share market, remember the American economy is great. It's doing well. It's solid. It's got little patches here and there, but you'll find that if you microanalyze anything. But basically, the U.S. economy is great. What is a really big issue that could bring it down? Well, the only one that I can think of is property. And I expect that the Australian property market is going to get a lot worse. And I think you're going to see that happening in other parts of the world as well. And you may see the weakness that's been telegraphed in Manhattan and the Hamptons, the real high-end stuff. You may see that spreading. If it does, watch out. Anyway, I guess that's about us for the day, folks. I do hope you've enjoyed what we've talked about. I hope I've shown you another way of analysing markets, a way that's unique to us and different to anyone else, and that you can see how on the angular charts we've been given an opportunity to look at an entirely different metric when we're doing our analysis. If you want to learn how to do all this stuff for yourself and be a super trader, really, and you should be, because the days I think of buy and hold are probably over. If you want to protect your stock market wealth, you ought to know how to trade futures. And if you do, give me an email. Let me have your phone number and country so I don't wake you up in the middle of the night, and I'll be happy to call and talk to you about your trading and what you could gain from attending a Daniel Code tutorial where I teach you everything you need to know. Free trials, if you haven't already, folks, please feel free to have a free trial. Thanks, Murph. I see you're going. Just go to the Daniel Code website, www.thedanielcode.com. Click on the free trial, and it will switch you on for a free trial of everything for 14 days. If you have any trouble at all, contact Terry at support@thedanielcode.com, and he will expedite your free trial. Here's our compliance statement, folks. Always need you to be aware of it. It's real easy to lose money trading. Let me tell you, the easiest part about trading is losing money. Don't trade any real money, I implore you, until you are confident that you know what you're doing. The best way to get to know what you're doing is to take a Daniel Code tutorial. I will teach you to be a safe and successful trader. Okay, so that's about us for the day, folks. John, working up there, Kuhn and Parabrand. I was up there not so long, mate. I'll tell you the story one day. It's for a reason you couldn't possibly believe. Actually, you could. I was on my way down to Orange, my God, to pick up a puppy for Mrs. Needham. The things you do for your family, eh? Okay. Tom, thanks for being with us, mate. Grand to have you all with us. Look forward to talking to you again in another couple of weeks. All the best, folks. Have a pleasant weekend. Bye-bye.